One of our clients at McPhee Insurance sent us a Dave Ramsey video. In this video, the caller is a whole life insurance agent. George asked us to comment on this video. So, George, this podcast is especially for you.
Dave puts all whole life insurance into one bucket. Base insurance along with a policy designed for high cash value life insurance. Then he takes the worst whole life insurance example and compares it to a very rosy investment picture.
It's this kind of media that's very confusing to people that are looking to infinite banking as a way maybe to create assets in their life and wealth that is beyond Wall Street.
So Elliot calls into this show. He's a top 20 business school graduate. He sold triple net investments for a while, and now in the last year, he's been selling whole life insurance.
My name's Elliot. I graduated from a top 20, business school in college. After college, I sold triple net investment sales for about 2 years, and then for the last year, I've been a whole life agent.
So he tells Dave that he pitches whole life insurance as a savings tool, not as an investment. He's not trying to compare it to high investment returns, and he believes he's leaving his customers better off than before he talked to them. And he wants to know, why doesn't Dave think so?
And to be real frank right up front, the kind of life insurance Elliot is selling, $50 a month premiums.
I've never sold a $200 a month premium policy.
So probably more like 100.
On average, it'd be more like between 50 and 70.
Okay.
I would say.
The clients would probably be better off with a term policy.
They probably would. Yeah,
because it's not built for high cash value.
No, and with that low of a premium going into a whole life insurance policy, you're not going to be able to build it for high cash value. Maybe if it's on a child, but Elliot is saying his typical customer is at the average Joe who works construction, around 30 years old. That's not going to work out very well for building high cash value in a whole life insurance policy.
But that sure doesn't keep Dave Ramsey from jumping on this whole thing and condemning whole life insurance as a whole asset category.
The product is crap.
Instead of looking very carefully at saying, no, Elliot, this probably would be better to serve your clients by buying term and investing the difference, which in our opinion probably would turn out better than what Elliot's doing here.
At the same time, with a little bit more knowledge and understanding of the whole life insurance product and how it could benefit his clients, Elliot would find that whole life does serve them well if he can convince them that they need to spend higher premiums for the reward that whole life insurance is going to be building for them. The high cash value that they want is available, but not at the price that he's trying to sell it to them.
Exactly. So let's think about the average Joe. He's working in construction, making $45,000 to $52,000 a year on average. He's making close to $4,000 a month. We'll round it to that. He should be saving at least 10% of everything he's making. That's going to be about $400 a month.
Not 50.
Not 50. So if we look at the whole life insurance combining the savings component along with this, maybe he should be putting more like $400 a month into a premium. This is totally opposite the way that most people think of life insurance. You want to pay as little of a premium for as much death benefit as possible. But that's different when we're talking about whole life insurance that's designed for high cash value, that you're going to use as a savings tool, that you're going to use with the infinite banking concept. Nelson Nash specifically talks about in his book that with that type of design, you have to change your thinking. You want to pay as much premium as possible for as little death benefit as possible when you're thinking about the savings element. Now, this may not give Elliot the total amount of death benefit that he needs. He may need to buy some term insurance along with this.
Depends on what his liabilities are at that time.
Yes. So let's say he does put $400 a month into a policy that's designed for high cash value. If it's designed for high cash value, the death benefit is going to be about $140,000. He could get a similar term life insurance policy that's going to give him a similar death benefit for probably around $20 a month or less. $14 to $20.
And Dave Ramsey mentions it's going to take $9 or $10 a month to get $100,000 in term. Right. Actually, it could be done for about $8 or $9. So he's right on. He's pretty close there on what the term
stock
is
held
costing.
companies. So maybe he's not using a mutual company. Maybe we were seeing that $8 to $9 a month. Yeah.
Right. $50 isn't going to really cut it. But $400, wow, that's a huge jump. We could design a high cash value policy even for $200 a month, assuming that this person is around 30 years of age. Now, the results aren't going to be as good,
Right.
but it could be done. So even if someone isn't willing to do the 10%, which would really be a great starting point if you're really building for a retirement future, if you're building cash value that you're going to like the looks of, that you can use along the way to your retirement, you need to start with that higher amount. But if you absolutely can't, or just can't wrap your mind around that, start with that lower amount, the $200. That would work also. $50 a month, that's not cutting it.
Anyone that listens to this entire clip of this Dave Ramsey show will find out that Dave Ramsey uses numbers and he jumps all over the place trying to find the numbers that fits his example the best.
Yeah. So he starts out with a $200 a month whole life premium and this $10 a month term. And then he jumps. He finds out Elliot's not selling policies that big. So he goes to $50 to $70 a month, but then he jumps again.
He does. And, someone that holds himself up as a financial expert needs to be using accurate numbers. This hodgepodge of numbers where you just throw it out and make up something as you go along just doesn't cut it for people that are planning for their future and wanting to know that they're going to get there and have enough money when they do.
Something that came up in this is Dave talks about at the end, he said, well, they don't have the money because they gave it to you for the whole life insurance. So they're not saving what they need to for retirement. If they would put this money into a Roth IRA, they'd be millionaires by the time they retired.
I think a problem that it is helping is that people do only retire with about $5,000 in their bank account.
Well,
So at
that's
least at the
because
end
they
of a
bought
whole
this
life policy-
crap.
They didn't have any money to invest because they gave it to
If
you.
you put the $95 in a Roth IRA, they would retire millionaires.
At that point, he had jumped to $95 a month going to the Roth IRA. So if we put $95 a month going to a Roth IRA for 30 years, this is a 30-year-old, let's say, we jump 30 years down into this picture, he's not a millionaire by this time. If we give, let's say he earned 12% on that investment every year. Dave Ramsey likes to use 11 or 12% returns on his investments, by the way, and we take out a 1% management fee. This guy only ends up with $245,000. He's not a Roth IRA millionaire by any means. If we compare a more reasonable investment return, because he's probably not earning 12% on the Roth IRA. Let's say he even earns 7% on the Roth IRA minus a 1% management fee if we put that into the Roth IRA, he's got like $94,000. So it takes like $245 down to about $94,000. Now, is he going to have that much money if he puts $95 a month to a whole life policy? No, he's not going to have that much money. But we already established the fact that he really needs to be saving closer to 10% of his income. If he's putting 10% of his income to a whole life policy, he is going to have more than $95,000 of cash value.
Well, the cash value in the whole life insurance is not taxable either, where he is going to have the taxes once he starts accessing the investment as well.
For most investments, yes. Dave Ramsey was talking about a Roth IRA here.
Oh, okay.
So he wouldn't have taxes when he accesses that.
Sure.
So you're right. With whole life insurance, policy loans are not taxable. You can access the whole thing. Now, if you surrender the policy and walk away, then you're going to have tax on the growth from whatever you paid in premiums. You get back tax free. But then if you take out more than that out of the policy and you let it surrender or whatever, then there would be taxes on that if you're still living. But if you let the death benefit pay out, there's no taxes on that to your beneficiaries.
And of course, Dave is expecting that investment to grow compounded, uninterrupted. But life happens.
It sure does.
We talk to people all the time that life happens. Their children come home to live with them, or their grandchildren need assistance because one of the parents is gone, either through death or through divorce or some other thing. And now grandparents are taking care of grandkids. We talk to people that they find their parents needing assistance in their older years, and now they have to tap into their investments to help support their parents or to help a student get through college or to start a business. And when that happens, all that is showing, that's all going to deteriorate what Dave Ramsey says is going to be accumulated there when we get to retirement, when people that are saving get to retirement.
It's true.
That doesn't necessarily hold true in a whole life insurance policy. A whole life insurance policy built for high cash value and infinite banking is going to allow you to tap into those funds and not force you to lose the earnings on those funds. And that's the huge difference that Dave Ramsey's prejudice against whole life doesn't allow him to acknowledge.
Yeah.
That is such a stark contrast.
The idea that you can get a higher rate of return in an investment, yeah, it's true over a long period of time, but what time frame? And what's the market going to be doing during that time frame? And when are you going to need to access some of that money along the way? Those questions throw in wild cards that you absolutely have to have a foundation of savings in this environment. If you're putting everything into the investment bucket, you're standing to lose big time.
And not only are we talking about a certain amount of time, when we talk about time, we're talking about a beginning and an ending, and we don't know when that ending is going to happen and what the market's going to be doing at that point.
Right.
So if we look at historical market returns, you could have been doing great up to 2007, and you could have lost 80% of what you had.
Yeah.
You could have been doing great up till 1982, and then boom, people lost a ton of money at that time. I remember Walter Updegrave writing for CNN Money at the time saying, "Oh, don't worry about what you lost in 2008. Just continue to put your money away and earn a 10 to 12% return. 10 years, you'll be right back where you were before." But there again, the time equation. You've lost everything you could have earned in that last 10 years if you hadn't have lost money in 2008. And those things aren't considered when Dave Ramsey just blows off whole life insurance with a prejudice that is almost hatred.
And for people who have done well with their finances and they have lots of resources when they get to retirement, having cash values and whole life insurance can really help them when those RMDs kick in, those required minimum distributions, or when the market is at a slump. You can access money through the whole life insurance without upsetting your investment or creating extra tax consequences. So whole life insurance gives you options. It's a great tool.
I was looking at an example the other day where if somebody had started putting $10,000 a year invested into the S&P 500 starting in 1995, they would have had the benefit of the years leading up to the dot-com bubble. Mm-hmm. So investments would have been looking good during that time. But then you had 3 years where the market was down. 2000, 2001, 2002. If you look at the returns after that period of time, you would barely be breaking even. Maybe a little bit of gain there. But then you had some build-up years then, again, from there till 2008 hit. And then you had a loss in 2008. After you'd been saving for 14 years at that point, 14 years, you have a negative return. Now, if you would have continued investing $10,000 a year, every year up through 2024, you would be positive again, like in the 8% range. That's where we see a market return coming in. But what if you needed money at year 8? What if you needed money at year 14? What if you needed money at some of the other down years along that time? You're not going to be getting that 8% return because it doesn't matter, what returns you got in specific years. Yeah, you had double-digit returns in some of these years, but you also had double-digit losses. And so that time factor, that's so important. We have to start from a foundation of savings. What better place to build that foundation of savings than in whole life insurance, where we know we're going to get a steady return, especially if it's designed for high cash value. Just a regular base whole life insurance policy that's growing at the 1.2% that Dave Ramsey's talking about, yeah, that's not going to cut it.
Besides messing with the truth, come back from the break to find out what else we don't like about how Dave Ramsey addresses his callers.
This is the Infinite Banking Made Simple binder. Everything you need to know about infinite banking in one spot. And it's a free download. Answers to the top commonly asked questions like what is infinite banking, how does it work, and how much does it cost to get started are answered right here. You'll find the step-by-step diagram starting on page 7 and the investment comparison on page 8. This Infinite Banking Made Simple binder is a free download. You can click the button to get your copy. At McPhee Insurance, we believe infinite banking has become too complicated and confusing, but it shouldn't be. And that's why we created this binder. Infinite banking is simple when you stick to the essentials and the facts, and the people who put it into practice get results. Don't let insurance terms like modified endowment contract, 7-pay test, direct recognition, and paid-up additions keep you from understanding infinite banking. Download the free binder and see how infinite banking can work for you.
Nelson Nash talked about the premise of the infinite banking concept, and he gave some different analogies to talk about this. He talked about the water system in the world. We have the oceans, we have the process where evaporation takes place and forms the clouds, and then we have rainfall in different parts of the world, and that rainfall accumulates into lakes and rivers that eventually end up flowing back to the ocean. And somewhere along the way, that money flows through you and me. And I remember at this point during his seminars, he would pause and he would take a drink out of a glass of water to prove his point. The water system in the world is not stagnant. It's always flowing. And the same thing is true with money. Now, in order to control the money that relates to our needs, we have to have a place for that money to reside. Otherwise, it's just going to flow through us all the time. We're not going to have any extra reservoir when we need to use it for something. And so Nelson Nash talks about the infinite banking concept being all about how much of the banking equation do you control as it relates to your needs. Mm-hmm. That's what we use whole life insurance that's designed for a high cash value for. We use it as a reservoir for our money. Money that goes into a life insurance policy isn't just sitting around buying a death benefit. It isn't just sitting around earning a low rate of return. It's money that's sitting around ready for us to use throughout our lifetime. And while we're saving it there, it's not just inactive because the life insurance company is helping us put it to work.
Some people use a 401k for their reservoir, or an IRA, or a Roth IRA. And they have to look, though, how much control do they have over their 401k?
Well, they could invest it differently, within the limited investment menu. Mm-hmm. If they have an IRA, they have a wider range of investments that they can invest it in.
I'm just thinking of our trip to Israel a few years back where we went to the Sea of Galilee, a nice fresh lake, bubbling, getting the snow melt and everything, and then the Jordan River going down the valley. And we ended up at the Dead Sea. Mm-hmm. And the Dead Sea is like getting into a bath of diesel oil. It is stagnant. It doesn't flow. It's dead. And I think of this often when I think of finances because I think of what you said about Nelson Nash talking about this, John. And that's often what happens with a 401k or Roth. It's just a dead pool of money that you have no control over. It limits your ability to live. It takes away from what you can do today, putting it off toward tomorrow. It's kind of a hoarding system rather than an active, vital, living organism, which we want to help money do because money has to flow just like water has to flow, otherwise it becomes stagnant. Mm-hmm. And so if we get to control that flow, and that's what Nelson Nash's whole idea about infinite banking was, is how much of this flow of money in the banking system do we get to control? And if we get to control it, how many times do we get to use it over and over and over again in our lifetime instead of letting it just all heap up in the Dead Sea and become stagnant and hope it's there for us to use? I mean, who wants to take a drink out of the Dead Sea?
Ooh, yeah, not me.
No one. No one wants to take a drink out of the Dead Sea. If you think about it too, term insurance, you're always paying for. You're always going to be out of pocket for term insurance. Always. Never builds any equity. You're always paying. You're renting your life insurance, basically. Whole life insurance is different. It builds equity. Some whole life insurance doesn't build equity very well, but if it's designed for high cash value, you should, in a good policy, you should have a point, usually between 9 and 13 years on a policy, where your cash value is more than all the premiums that you've paid. This means you could walk away with your cash value and actually walk away with a profit for having your life insurance over those years.
And on top of that, John, between years 4 and 5 on a high cash value life insurance built for infinite banking, we're going to be cash flowing in that, which means that we're going to be getting more cash value build up in the year that's more than what the premium was paid for. And that's what every business owner looks for is, when am I still going to cash flow in this business?
Yeah.
How long is it going to take before we start turning a profit on what we're putting into it on an annual basis?
Yeah. That's super important. It helps you keep it going at that point. So the capitalization phase, it doesn't have to be as long as many people think. But let's just put this into a logical exercise here. Dave Ramsey's recommending term insurance. He said you rent it and you're done. It's cheap, but at some point you will be done because the premiums on term insurance are going to go up so astronomically high. You're not going to keep the policy. Nobody does. With whole life insurance, if you design that, participating whole life insurance policy designed for high cash value, the life insurance company on the participating whole life insurance policy, they have to share the profits of the insurance company back with the policyholders. How are you going to come out behind on that? You can only come back out behind if you think you can get a higher rate of return somewhere else. But then you have to take into account all the timing that has to go into that. And the fact that if you wanted to use the money trying to get a higher rate of return somewhere else, you're going to lose that compounding curve every time you do it.
I remember when we were first introduced to infinite banking, and I took the book to a CPA that I trusted, and I said, would you read this? And he read it, and he gave it back to me, and he says, anytime you're part owner in a company that you're paying interest to, you're going to come out a winner.
Yeah.
And so we're part owners of the whole life insurance company, the mutual whole life insurance company.
Yeah.
And Dave Ramsey recognizes the life insurance companies are profitable. There's a point in this video where he talks about, all the big buildings, the skyscrapers, the skylines of big cities, the banks and insurance companies, their names are often on these buildings. Dave acknowledges this. And he says, they didn't build those buildings. You did with the money that you gave them.
If you look in the skyline of the typical mid-sized city, the towers in the skylines, particularly 20 years ago and before, it would be two things: banks and life insurance companies. Santa Claus did not build those buildings. You did. You did. Your money went to them. You chose for it to go to them. They didn't steal it from you. But their products are so profitable to them, not to you, that they own the skylines. Don't you just wish you had the bank furniture? They got the best furniture.
Here's where I feel a little bit of jealousy coming out in Dave Ramsey's analogy here. Dave Ramsey's a real estate owner. That's how he got and made his money. And so we could say, Dave Ramsey, where did you build that? How did you build that $10 million house? You didn't build it. Wasn't it all the people that are buying your get out of debt packages and your books and your seminars? They built it. Why aren't you giving the money back to them? I mean, this is such a stupid analogy that Dave says. Of course the insurance companies invest that money wisely. They would be untrustworthy servants if they didn't. They know that commercial real estate is one of the highest, most steady types of investments that you can make. And so that's where they put their money, because they know that they're required by law to pay a death benefit if you should die, and they better have the resources to do it. So they do something stable instead of investing in mutual funds like Dave Ramsey suggests we do.
And even though the names are on these buildings, they're not necessarily using all that space. Most of the time, they're not. They're leasing it out.
Just here in Indianapolis, at one time, it was the largest building in the city. One of the insurance companies that we represent, they're a mutual life insurance company. As of a couple of years ago, they were only using a couple floors. They might be using less now with more people working at home. But what they do is they lease out the rest of that space. That is cash flow that they are bringing in to help their company be profitable so that they can share dividends with their policyholders and so they can pay those claims that they are obligated to pay.
And, living here now and being in downtown Indianapolis a little more frequently than when we lived in Nevada or Oregon, we find out that this insurance company owns a lot of other real estate, like parkades and stuff downtown Indianapolis. They are generating good capital so that they can pay good dividends to their policyholders.
Another company that we represent has offices in 3 different locations, a couple in the Midwest and one in New York. We visited one of the Midwest locations. Now, it is not a tall skyscraper, but it had a second building on the property, on the campus, and we noticed it had a different insurance company's name on that piece of property. So while we were visiting there last fall, we asked them, what's with this other insurance company? And they said, well, we used to use both buildings, but in 2020, things kind of changed around. More people were working from home. We realized we didn't need that second building, so we leased it out to the other insurance company, and that brings us more profit.
That's a great example. They're keeping their assets at work, and part of that work is why they're able to pay the claims on their policies.
So when Dave Ramsey talks about becoming a millionaire, putting a small amount of money every month into mutual funds like he recommends, he's talking about high-risk mutual funds. Because
if he's trying to earn 12% on them, yeah.
That's the opposite end of the scale of what parking money in whole life insurance does. Yeah. Parking money in whole life insurance is guaranteed. You don't assume any risk. The insurance company assumes it for you, and they assume it because of the good investments they have made and continue to make with the premium dollars that you're paying. Yeah. But the whole idea here is not that we're just earning the 3 to 4% that a whole life insurance policy can earn over its lifetime. We're talking about the use of money during life, as life happens, instead of hoarding up a bunch of money for a time that we don't even know we're going to attain to. And if we do, we don't know what the tax rates are going to be on, and we don't know how much of that money is actually going to be there because of market volatility.
Yeah. And most wise investors, if they're investing, even if they're investing in a mutual fund that's going to try to earn 12%, they're not going to have 100% of their portfolio in that fund because they know it's going to be volatile. They're going to split it up. Some of it's going to be more safe and secure and earning a lower rate of return.
I think about our last podcast when we were talking about Paul Atkins, the chairman of the SEC. Here's a multimillionaire, $327 million his net worth is, and he has more than 10% of his net worth in high cash value life insurance. Is he a fanatical ignoramus like Dave Ramsey talks about here?
Yeah,
I don't think so.
By the way, folks, I'll help you with this. You get screwed way more often by enthusiastic ignoramuses than you do actual con men. There's not that many actual psychopaths out there like a Bernie Madoff. There's a few of them. But your friend who's trying to talk you into Bitcoin is an enthusiastic ignoramus.
I agreed with Dave Ramsey on this point. He was talking about how most people that where you'll get hurt financially are going to be enthusiastic ignoramuses, not actual con men. Because they're not trying to hurt people, but they believe something that just ain't so, as Will Rogers used to say. I would say that's true. There's a lot of people in the financial industry that don't necessarily understand the products that they're selling. Maybe this caller who's calling in about the $50 to $70 whole life policies, maybe he is one of those. But he seems to be approaching this in a thoughtful way. But yeah, $50 to $70 a month probably isn't enough to really get a good policy. But that part's true. But then Dave Ramsey takes it a step further, and this isn't only an isolated case on his radio show, but as he's talking to this guy, he becomes very derogatory. Mm-hmm. Sometimes he'll even attack the person when he can't attack their logic. We see that on his show, and that's not a good excuse.
That isn't.
He's right that a lot of enthusiastic people that are wrong can lead people astray. That probably happens more often than talking with an actual con man.
But I think he should look at the old axiom that says if the shoe fits, wear it here, because he is using that same attitude to condemn the people that he doesn't agree with. And I think of Thomas Sowell, who said, the truth isn't that complex. It's evading the truth that becomes real complex. And as we listen to this interview or this caller and Dave Ramsey interaction with it, it became so complex that we deal with numbers all the time, and we were having to sit down and write these numbers down and compare and say, boy, this he's jumping all over the place. This isn't even logical.
One of the things that Dave Ramsey pulled out, I think that this was toward the end, he said, you have to be careful about pressing the poor. Don't mess with the poor. with this. If you're selling these, in this case, he's saying this guy's selling $50 to $70 a month policies. He's working with the poor here. You got to be careful that you're not oppressing them. That's a good point. If Dave's going to apply this logic to somebody else, there's a Bible verse that talks about by the standard and measure that you deal out to others, that you're going to be judged by that yourself. Dave needs to be careful on this, because it's very often on his show, he's talking about 11, 12% returns. Well, is that oppressing the poor by setting false expectations?
That's a very good point. I can't help but think of Justice Louis Brandeis, who was appointed a Supreme Court justice back in the 30s, I believe. He was called the justice of the people because he took and was an advocate for the low-income and middle-class people, because he saw they would be taken advantage of by people that were projecting larger returns than that would be able to be delivered, or even shady companies that were taking advantage of the poor. And he stood up for their rights, not only personally, but as a justice. And when he left the Supreme Court, he started a life insurance company because he wanted people to be able to have a guaranteed legacy that they were able to build. And Louis Brandeis's life insurance company is Mutual, and it still exists to this day, helping people that really need those guarantees and don't want to participate in the high risk that Dave Ramsey's talking about.
I was talking to a guy that used to be high up in marketing for Primerica, and they're the big buy term, invest the difference. I had a video on my LinkedIn feed that was talking about A.L. Williams, how he made his money in the 1970s. But there's a place for term insurance and there's a place for whole life insurance. And he looked at that video clip. He told me, "You're right. You're right on." Primerica made their money selling, buy term and invest the difference, but they left out some of the foundation in some points. And he told me his mom had a Primerica agency for years, and she became disenchanted because her clients did not get the investment returns that were promised by buying term and investing the difference.
Well, that's more than one Primerica agent that we know has been disillusioned with the A.L. Williams' vision of life insurance. I remember attending a Nelson Nash conference, 2-day conference, and at the end of the conference, there was a gentleman stood up at the back of the room. He says, "I'm guilty. I'm a Primerica agent. I've been one for 19 years. He says, "From now on, I'm going to teach the truth."
Good for him.
Sometimes Dave Ramsey mixes the truth together with something else. For example, when he says millionaires don't use payday loans, probably not. They don't rent to own, probably not. And they don't use whole life insurance. And that is false. We have so many clients here at McPhee Insurance that use whole life insurance.
Multimillionaires and millionaires, we don't find them using payday lenders, rent to own, whole life insurance. We don't find them using rip-off financial products.
This is what we don't like about Dave Ramsey's show. Not that he doesn't give good advice sometimes, but he mixes it in with a bunch of hyperbole
and
that makes his credibility be completely reduced down to something that you have to question everything he says.
And I think he has a point that probably a lot of the millionaires he has surveyed haven't necessarily used whole life insurance, but that's not necessarily because they knew about it and chose not to use it. It's because of what has happened historically. If we look back historically, and this is in the back of Dad's book, Winning Your Financial Game, where there's a timeline of life insurance. Back in 1930, 120 million life insurance policies were in force, providing $117 billion of coverage. That was equivalent to a policy in force for every man, woman, and child in the United States at that time.
And what year was that?
1930.
Wow.
Then we went through the Great Depression. We know that there are lots of stories of people who used their life insurance to help get through the Great Depression. We go to 1979, though, and the Federal Trade Commission this time published a scathing task force report on life insurance, and it caused a downswing in the purchase of permanent life insurance. That was right about the time A.L. Williams was promoting buy term and invest the difference very aggressively as well, and we know that didn't work out for everybody that tried it either in the long run. But back then, in 1979, rates in the market had been doing great, and interest rates were high. So it looked like there were a lot of better solutions than whole life insurance.
I think that's about the time that E.F. Hutton introduced Universal Life too, which is a term product that earns an interest rate based on those high interest rates that were happening in the market.
And those policies, a lot of them fell apart through
Millions
low
of dollars have
interest
been
rates that we
settled
saw.
by insurance
Yeah.
companies to pay out for those policies too.
Yeah. So we had a culture shift. This FTC report comes out in 1979. Buy-term invested difference is very popular. I'm not really surprised that a lot of the millionaires Dave Ramsey is talking to today didn't use whole life insurance. They're coming out of that era.
Yes. And I think if we look historically, we look at John Wanamaker, like we talked about last week on the podcast, multimillionaire, even in his age, highest insured person in the country, second highest person insurance in the world. We look at J.C. Penney, we look at Ray Kroc, we look at Christopher Doris, Doris Christopher, the founder of Discount Tire. All these people used whole life insurance to build their millions. Walt Disney. We could go on and on and on about all the people. Dave Ramsey might just be interviewing the wrong millionaires.
Yeah.
So if you're trying to get out of consumer debt, you may need a step-by-step legalistic system to do that, like Dave Ramsey projects. However, if you're trying to control the banking equation in your life and to recover interest and principal that you lose when you buy assets or other products, then you need infinite banking.
Infinite banking is a process that just so happens to work best with whole life insurance that has been designed for high cash value.
If you have questions or things that you would like us to talk about on this podcast, like we did with George's request today, send us an email, producer@wealthtalks.com. Next week, we're looking into the wild world of Jim Cramer, a financial guru who yells his stock picks on CNBC's Mad Money program. Is he a financial genius or a loudmouth? Find out next week right here on Wealth Talks.